After studying this module, you would be able to know about 4 types of strategic controls. Understand the difference between strategic and operational control. Know about the techniques of strategic control and operational controls. 4 types of strategic controls. In general, control is ex post analysis, that is, actual outcomes are compared with the planned outcomes. However, the scope of strategic controls are much wider, and they not only compare actual outcomes with intended outcomes, but they also act as a steering mechanism, that is, they also ensure that activities are performed and outcomes are achieved in a desired manner. Hence, strategic controls do not merely evaluate strategy in the end, but they simultaneously initiate from planning process of strategy formation and go till the end. There are 4 types of strategy controls, and these are premise control, implementation control, strategic surveillance, and special alert control. Diagrammatically, the timing of each of these controls can be shown as follows. The strategic surveillance mechanism comes first, then we have premise control and implementation control, and finally special alert control. There are 3 ranges. The first range is environmental scanning, the second range is strategy formulation, and the third is strategy implementation. Now let us take up each of these. Premise control. Strategy is developed under certain basic assumptions known as premises. The successful implementation of the strategy depends upon these underlying premises. Since strategy is a long-term plan, there is a time lag involved between environmental scanning, when premises are identified, and implementation of strategy. Due to this time lag, there could be changes in some of the premises identified during environmental scanning. The change in premises can hamper the effectiveness of strategy. Hence, certain adjustments are required in strategy to counter changes in premises and so the intended outcomes could be achieved. Thus, organizations should carefully keep track of premises underlying the strategy. Premise control is specific in nature because it is only concerned with premises used in the formulation strategy. An example of change in premise is that during environmental scanning, an economy may be booming. However, during the implementation stage of the strategy, the economy may be facing a recession, and strategy based on a booming premise will not work during recession. Implementation control. As events turn up during implementation of a strategy, it sometimes becomes necessary to adjust strategy to accommodated consequences that have unfolded while implementation of a strategy. Sometimes it is only possible at a later stage to determine whether strategy can be preceded in a desired manner or any adjustment is necessary. Strategy is implemented in an incremental phase, and it is possible to assess and review the implementation of overall strategy by analyzing the results of activities conducted in the incremental phase. There are two types of implementation control. One, monitor of projects thrust strategy is implemented with the help of various projects. The analysis of progress of undertaken projects helps in assessing the overall effectiveness of strategy in future. If undertaken projects are completed successfully or are progressing in a desired manner, then it is a positive indication of effective implementation of overall strategy in future. However, if the undertaken projects are not completed successfully or are not progressing in a desired manner, then it indicates that some adjustments are required. So overall strategy can be implemented in an effective manner in the future. Review of milestones. Organizations should identify significant milestones in a strategy which can help in assessing the effectiveness of overall strategy. When identified milestones are achieved in a desired manner, then positive assessment of the overall strategy and no adjustment is required. However, if identified milestones are not achieved in a desired manner, then review and adjustment in the overall strategy is required. Implementation control is also specific in nature because it only analyzes undertaken projects or significant milestones identified by management. Strategic surveillance. In contrast to premise and implementation control, which are specific in nature, strategic surveillance is general in nature. It covers a wide array of both events inside and outside of an organization that may significantly impact effective progression of strategy. Though it is general in nature, it can still unearth significant information and events that can have a material impact on the course of strategy. Thus, strategy needs to be adjusted in the light of revelation of new information and events. A strategic surveillance is general in nature, so it is based on multiple sources of information. Due to its wide scope and general nature, it can foresee any unanticipated event in the environment and take proactive steps to counter such unanticipated events. Thus, strategic surveillance, though very flexible due to its generalness, provides wide vigilance to an organization, which is helpful in revealing information which is significant to an organization. Special alert control. Special alert control is an emergent situation in which strategy is reassessed promptly in the light of occurrences of sudden unforeseen events. These sudden unpredictable events may be in the form of calamities, terrorist attacks, product defects, chemical spills, and so on. The Bhopal gas tragedy of 1984 caused the Union Carbide factory to close down. Then Maggi noodles were found to be defective, and this also led to problems. The organization should have had a contingent and emergent plan to tackle these sudden unexpected happenings. If the organization does not come with a contingent plan to counter any of the emergent situations, then the organization's survival is endangered. Strategic controls are not just end controls, that is assessing strategy at the end, but these are ongoing and steering controls which ensure that strategy works in a desired manner and helps organizations to achieve outcomes in a desired manner. If controls identify that strategy is not working in an intended manner, then some immediate adjustments are made in strategy so as to ensure that the strategy achieves the intended outcomes. Sometimes in extreme situations it may happen that due to happening of some unexpected events, current strategy becomes irrelevant and antiquated for the current situation. Under such a scenario, organizations should abandon such antiquated strategies and develop new strategies and it is relevant that are relevant and effective under the new conditions. Difference between strategic and operational control. As already stated, the strategy is implemented through various programs and budgets made for various divisions, departments and units of an organization. Strategy is a broad and long-term plan operating at the organizational level and is made functional with the help of various programs and budgets. Programs and budgets are more specific in nature, that is, it is made for specific divisions, departments or units of the organization and it is short term in nature. Hence, strategy becomes operational only when it is divided into various operations in time periods. Diagrammatically, it can be shown as follows, that we have overall strategy which is divided into 4 different operations, and at time level 1 the operation 1 is effective and there is a budget for at time 1. Similarly, there are budgets for operation 2, operation 3 and operation 4. Each one has a budget at time 1, time 2 and time 3 and so on. In the above diagram, it can be seen that there is a different budget for each operation under the strategy and each operation has a budget for a different time period. Strategic controls are devised for monitoring and steering of strategy. In contrast to operational controls, they are devised for controlling various operations under strategy. We have a table which has 3 headings: points, strategic control and operational control, for looking at the contrast between operational and strategic control. The first point is about level. As far as level is concerned, strategic control functions at the organizational level. As far as operational control is concerned, operational control functions at the division level, the department level or the operating unit. The time horizon, as strategy is a long-term plan, so strategic controls have to be long-term in horizon. As programs and budgets are short-term plans, so operational controls have to be short-term horizons. Emphasis, strategic control mainly analyzes external environment, since the relevancy of strategy is in given circumstances mainly depends upon the external environment. Operational controls mainly focus on internal factors, although effectiveness of strategy depends upon strategic control, but operational control ensures efficiency depends upon internal factors. Accountability. Top management is solely accountable for developing and operating strategic controls within the organization. The divisional, departmental or operational managers are accountable for implementing operational controls within their operational area. Types of techniques, both financial as well as non-financial techniques are used in strategic controls. These techniques could be ex post or ex ante. In the case of operational controls, what we find is that the mainly financial and ex post techniques are used in operational controls. Techniques of strategic control. Strategic controls are implemented at the organizational level, and they not only evaluate intermediary progress of strategy but also ensure effectiveness of strategy in future. Thus, strategic controls are not just appraisal tools, but they are also for effective monitoring of the progress of strategy in future. Hence, a wide variety of techniques are used for strategic controls. These techniques range from financial to non-financial, ex post to ex ante, and can be showed in a 3x3 matrix as follows. One dimension is ex post and ex ante. So, we have 3 columns: ex post, mix of ex post and ex ante, and ex ante. The other dimension is financial or non-financial, within which we have financial, mix of financial and non-financial, and non-financial. So, if we observe the matrix, then we see that ex post and financial, this involves return on investment, earnings per share, and price earning ratio. If we move to financial and ex ante, it is shareholder value. Now we consider the next row, which is a mix of financial and non-financial. Management audit is ex post, mix of ex ante and ex post is balanced scorecard, and ex ante is corporate responsibility approach. The third layer or the third row is non-financial, and here we have corporate governance reporting, which is a mixture of ex post and ex ante. ROI or return on investment is calculated by dividing earnings before interest and taxes with total investments. Investments in ROI implies total of non-current assets and net working capital. ROI is relative measure, and this formula gives pre-tax return on per unit capital invested in business. In essence, ROI measures efficiency of funds invested in business. The greatest advantage of ROI is that it measures efficiency, which is of prime concern. However, it has several disadvantages, some of which are ROI is significantly influenced by the method of accounting policy adopted by the business. It does not consider time value of money. ROI does not consider the risk factor so as the business with high risk and profits will score better than the business with low risk and profits. ROI is ex post analysis, that is an indicator of the past performance of business, and hence does not reveal significant information about the future. Since ROI is ex post analysis, it does not take into consideration. So, managers that are appraised on the basis of ROI tend to focus on short term results rather than long term results, which leads to short term orientation and goal displacement, which in turn is detrimental to the organization's future prospect. Earnings per share and price earning ratio. EPS is calculated by dividing earning after taxes by total number of equity shares outstanding. In essence, it denotes amount of profit earned by a business per equity share. It is an absolute measure and it has the same disadvantages as ROI. On the other hand, price earning ratio is a relative measure which is calculated by dividing market price of an equity share with EPS. As it is a relative measure, so it is better than EPS, and if two firms are compared on the basis of price earning ratio, then a firm with a lower price earning ratio is better. However, it is an ex post analysis, so it has the same limitations as ROI. Now let us consider management audit. Management audit is a systematic and comprehensive appraisal of all management processes and functions. The scope of management audit is much wider than financial audit, since the latter is concerned with expression of independent opinion on the financial statements of an entity, but management audit is concerned with the expression of opinion on various management functions as to their effectiveness and efficiency. Hence, it is both financial as well as non-financial in nature, since it is concerned with both effectiveness and efficiency. Thus, it is the most important tool in the hands of top management for systematic assessment of various management processes in an organization and to know whether these management processes and functions are functioning as intended. Management audit analyzes the management processes and functions in the context of current strategy and may reveal problems that are hampering the effective course of strategy. Corporate governance reports. Corporate governance report is a non-financial report which expresses systematic opinion on the performance of board of directors in respect of effectiveness of the board in driving the corporate towards and vision. Corporate governance implies effective and ethical discharge of duty by the board of directors towards stakeholders of a business. The scope and context of corporate governance is evolving with time, and with the passage of time its scope has become multidimensional. Regulations 17 to 27 and Schedule 5 of the Securities Exchange Board of India, the listing obligations and disclosure requirements regulation 2015 specify the requirements of corporate governance reports for listed companies in India. Corporate governance report is both ex post and ex ante in nature, since it is not just to analyze the past actions of the board but also examines the future plans of the board. Shareholder value. Shareholder value means summation of the present value of all future economic benefits occurring to an organization. One of the most important merit of this technique is that market price of equity shares, when closely associated, are closely associated with its value. When shareholder value is positive, that is present value of cash flow is more than the present value of cash outflows, there would be an additional wealth to the shareholder. However, if the shareholder value is negative, then the shareholder wealth would reduce. Therefore, it is most important criterion for evaluating the performance of any business. This approach also gives due consideration to the risk factor, since it discounts future cash flows with appropriate risk adjusted discount rate. A positive shareholder value, which implies creation of value for the shareholder, is a positive appraisal of the board of directors strategy, and conversely negative shareholder value, which implies reduction in the value of the shareholder, is a negative appraisal of the board. Balanced scorecard. Balanced scorecard approach combines both financial as well as non-financial measures to improve and sustain organizational value added capabilities in respect of shareholder and the customer. This technique was introduced in 1992 by Kaplan and Norton to improve organizational overall effectiveness and efficiency. It appraises an organization from 4 perspectives. The first is the financial perspective. This perspective is from the point of view of the shareholder. This perspective implies that the ability of an organization to create value for it implies the ability of an organization to create value for its shareholders. Organization may adopt any of the financial measures such as ROI, EPS, PE ratio to benchmark its performance from any shareholder's point of view. This perspective mainly emphasizes efficiency. Customer perspective. The perspective is from the viewpoint of the customer and indicates an organization may adopt measures such as market share, customer satisfaction, etc. to assess its value creation assessment from the point of view of customers. Internal business process perspective. This perspective is related to organizational capabilities for the creation of value to both shareholders and customers. This perspective helps organizations to appraise its internal process and functioning of the organization and evaluate that whether the organizational internal processes are adequate for effective and efficient functioning of the organization. Learning and growth perspective. This perspective focuses on learning and growth so as to enhance organizational capabilities in various areas which shall ensure the survival of an organization in the long run. Hence, this perspective aims at developing potential of an organization in the future and its prospective nature. This perspective aims at training and development of employees, improvement in communication systems, motivation and innovation. Thus, it can be seen that the balanced scorecard is not just restricted to financial performance, it also aims at monitoring and evaluating various non-financial processes and functions. This approach aims at building both shareholder and customer value. Finally, it is not just only the focuses on past performance and functions, but also is futuristic in nature, that is, it also aims at improvement of the organization in future. Corporate responsibility approach. This is a more radical approach and it still is in the development phase. This approach aims at creating value from three perspectives: shareholder value, societal value and environmental value. This trifocal approach, which focuses not only on shareholder value but on organizational responsibility towards society and the environment. Thus, under this approach, organization is responsible towards society and environment besides the shareholders. Organization under this approach must improve and excel itself to create value simultaneously for all the three, that is the shareholders, society and the environment. Techniques of operations control. Operation controls are mostly financial and ex post in nature, and that is, first budgets are made for operations and then the actual performance is compared with the budgets to evaluate the performance. Operations are differentiated on the basis of responsibility centers. There are various kinds of responsibility centers. Some of these are expense center. When units are identified on the basis of expense center, then the units are made responsible for expenses incurred on them. Usually, the amount is sanctioned to these units through budgets. Managers responsible for expense centers are evaluated on the basis of the amount sanctioned through budget and actual expenses. Revenue centers. The units are identified on the basis of revenue center generating revenue for the organization. The revenue is generated through sale of products. Revenue center are also controlled through budgets. Sales are estimated for revenue center and these estimations are incorporated into sales budget. Sales managers are appraised on the basis of budgeted and actual sales. Profit center. The units are identified on the basis of profit center, are responsible for both revenue as well as expenses. Efficiency is the main criterion for performance of appraisal of these units. More autonomy is given to these units since they are responsible both for revenue and expenses. We have also another center called investment center. The units that are identified on this investment center basis are generally the strategic business units. They are autonomous units since they are not only responsible for their revenues and expenses but also the capital allocated to them. The performance of these units is measured in terms of ROI since they have to efficiently use the capital allocated to them. Now let us summarize what we have studied. The module discusses the strategic and operational controls. Initially, it discusses 4 types of strategic controls, that is premise control, implementation control, strategic surveillance and special alert control. And there are some differences between these different types of controls. Strategic controls differ from operational controls. Strategic controls are devised at the organizational level and have a long-term horizon. They just not evaluate the end result of the strategy but also keep vigilance on the progression of strategy. And thereafter we have discussed various types of strategic controls which range from financial to non-financial, exposed to ex ante, ROI, EPS, earning per share, P/E ratio and so on. And then we have considered various approaches such as the balanced scorecard approach, the corporate responsibility approach, and then finally we have considered various types of operation controls, and these are the expense centers, revenue center, profit center and the investment center.